This material is another alert for the American Stock Exchange. Today, we will discuss a signal warning of an approaching recession in the United States. It is about an inversion of the yield curve. The presented graphics come from the Guru Focus portal and the Federal Reserve Bank of St. Louis database. A yield curve inversion is a situation in which short-term treasury bonds are quoted with a higher yield than securities with longer maturities. Short-term bonds are, for example, 1-year or 2-year bonds. Long-term treasury bonds are, for example, 10-year bonds. The inversion of the yield curve of a pair of 2-year and 10-year bonds has always occurred 6 to 24 months before each recession since 1970. In July 24, exactly 24 months passed since the inversion of the yield curve. And on July 16, there was a strong collapse in the American stock indices. Although a month after this event, the indices have almost recovered their losses, I would like to draw your attention to another signal indicating that the bear cage has been opened. But look what is happening. Despite being very fat, the bulls are still ignoring the roars heralding their slaughter and continue their feeding as if nothing had happened. Exactly 4 days before the crash, I drew attention to a disturbing anomaly in the S&P 500 index, where the concentration of the 10 largest companies in the index had grown to a record 40%. But no one listened to me. Other factors that should worry investors include the extremely high Buffett ratio, the planned interest rate cuts by the U.S. Federal Reserve, and the very high ratio of individual investor involvement in the U.S. stock exchange. All these signals have been presented on this channel over the last month. There are other yellow and red lights on my dashboard, which I will inform you about in the next episodes. Prepare your portfolio for turbulence. Subscribe to this channel to receive further information.